This is a good start. By all counts, 22,044 is where the Nifty is coming up at. The Nifty Bank, by the way, is also starting higher. So 0.5% plus on the Nifty Bank at this point. 46,000, by the way, on the Nifty Bank. These are the opening rates which are coming through. And maybe just to look at the Nifty IT index, which was the big reason for the market up move yesterday. It's starting flat, not very much at all. So first rates on the indices. But Sonia is across on the big wall with more. Sonia.
Well, thanks a lot for that. Let's take it straight to individual stocks, right? I think Britannia was really the stock in pre-opening that had the big move post its numbers. So Britannia, the first tick is up almost about 2% odd. We were talking about how some of these names like Tata Steel have been hitting fresh 52-week highs. By the way, the Nifty mid-cap index is now at a fresh record high. So that's been really the space to look at in the last couple of days. Mid-cap index at a fresh record high. Apart from that, getting back to individual stocks, many of these names, the Nifty IT index has been at a record high. So Infosys, TCS have been hitting fresh highs. Let's see if there's any follow-on buying. The IT index is in the green, but names like Infosys and TCS is seeing some follow-on buying, up about 0.3%. Tata Steel hit a fresh 52-week high yesterday as well. Maybe some follow-on buying there. Let's have a look at that stock. There you have it, up almost about 0.5%. Oil marketing companies have also been at fresh record highs. BPCL, HPCL, IOC. And this morning, the analyst was telling us how at IFL, how that is their favorite space to be in. So BPCL continues to see follow-on buying. IOC as well, up almost about 3% odd. Some result reactions that we're looking at this morning. Nykaa is up almost about 5% odd after a very good set of numbers. In fact, the profits have doubled on the back of a low base. The revenue growth has been in excess of 20%. So Nykaa is looking pretty good. Apart from that, you've also had the other platform companies, right? Delivery, PB Fintech, etc., that have also been reporting good numbers. So those stocks, maybe some follow-on buying. Delivery is up another 1.5%, while PB Fintech just giving up its gains a little bit. Max Financial up about 3.5% on the back of its numbers. The volumes are also picking up in Max Financial this morning. On the downside, you'd want to take a look at Naven Florine, because the stock has been at a fresh 52-week low for a very long time. And this time, as Sonal was telling us, numbers are very weak. So Naven Florine down about 1.5% odd. And some more in the broader markets include names like Endurance Tech, where the numbers were very strong, largely led by a recovery in Europe because of lower gas prices. So Endurance Tech is up almost about 0.6%. So lots of earnings impact is what you're seeing. Names like JB Chemicals, V-Mart, etc. also reacting to their numbers in the broader markets. Otherwise, it's a strong opening. The Nifty is up 100 points right now. The Nifty Bank is leading from the front this morning, up 300 odd points. Back to you guys.
All right. Thanks a lot for that, Sonia. Well, Paytm is a stock that's been wobbly in the last few days. It's still a fourth of what it was at its IPO price. The stock, though, is up close to around 5% as we speak. So there is some bottom fishing being seen on that one with big volumes. Aptus, housing, I think we should pull up that stock. There's a massive block that's taken place just in the first couple of minutes. Big volume spike. I think there was a large change of hands out there. So that one should be on your radar. Now the stock is more or less flattish as we speak. Stocks reacting to their numbers. You have Nykaa. Well, that stock is up and about. It's up close to around 5%. So big move out there. Zaggle, post its numbers. That as well is up more than 5% the last time I checked. EIH is seeing a big up move, in today's trading session. So EIH as well should come up for you on the screen. Balaji Telefilms, one of those stocks with massive volumes, that's up more than 15% in today's trading session. So keep an eye out on that one as well. And BLS e-services listed yesterday with solid gains. Today as well, in the first few minutes, there was big volume out there and the stock had popped up. It's up another 7% as we speak. Big up move on that one as well. And Azad Engineering, one of those stocks that has already seen a big rally in the last 1 month or so. Out there, you had the EBITDA number that came in high by close to around 85%. It was much better than ICICI Securities' estimate. So that one's up close to around 6.5%. And margins have jumped up to around 37%. On the downside, you have EID Perry that's seeing some selling. IOL Chemicals, that's another stock that's lower in trade. So some of them are reacting to their numbers. And Sirma is down close to around 10%. In pre-open, the stock was down close to 10%. Pull up Sirma up for you on the screen. And add to the list another stock, GSFC. So quite a few stocks moving around. Some big outsized reactions, both on the positive as well as on the negative side.
All right. So 100 plus points is what you have on the Nifty right now after all of the move that we've seen. Paytm, by the way, from the day's low yesterday, I think is up 150 rupees. Now that's a large, neat move that we've seen on Paytm from the absolute lows coming through. Now, a few other names. Inox India is the third largest volume-led gainer with a 4% pop right now. Zaggle reported numbers. It's a fairly recent listing. Stock's up 12%, 258 on Zaggle. We mentioned EIH. So, lots of sort of chatter around how valuations is compared to Indian hotels, etc., is much cheaper. And of course, it's a play in the hospitality space. Action Construction Equipment, the crane company, 5% higher. Stock's at about 1,040. It's got decent-sized volumes at this point. The JB we briefly alluded to, 5% on JB Chemicals. There is Gensol, which is up 7%. I mean, stock's been moving circuit to circuit for so many days now. By the way, Gensol is one of those names which is, undergone a bonus, a split. There was a pref issue at $1,000. It's done phenomenally well, the company. There is, what else? Nazara, we'll have the management with us in a bit, 4% higher on Nazara. V-Mart is up 8%. I mean, I think in my memory, it's one of those, it's after a long time that Nazara is, V-Mart has reported numbers which are good. I mean, I saw profits up some 40% or so. So we'll have more on that with the management a little later on the program. Market breadth is almost 5:1 in favor of gainers right now. A few names on the downside. I think some of these PSU names are seeing some pullbacks. HP is down 3%. This is only the starting rates. It's got large volumes. Petronet had a 6% move yesterday. Petronet is down about 2%. There is NLC India, which reported numbers. It's down about 3.5%. Reddington is another one, which is down about 4% or so. And Ajmera, which had a decent move yesterday, is down about 2.6%. So, some stuff on the downside. Nifty is kind of moderated its opening gains. It's down. It's about 25 points off the day's high, 30 points off the day's high, about 80 points in the green. Sunil Kaul is now joining us. He's APAC equity strategist at Goldman Sachs. Sunil, good to have you with us here. Thank you very much for your time. It's a strong start once again. What's the view, both tactically and a slightly medium-term view on the markets from here? Because we've done exceptionally well. The question is a pullback, or we'll continue to march higher in a very steady fashion. What's your sense?
Yeah, Prashant, pleasure to be back. Look, I think in terms of the strong start, I sort of mentioned this in your show last time. If you, for example, looked at the market returns last year, the market was up 20% or so, but a lot of that move was basically driven by underlying earnings accrual, right? And so in aggregate terms, the market was actually flat in terms of valuation. So at 22 times we started the year, that's where we ended on 2023. So in terms of that was a good move in terms of driven by underlying fundamentals. I guess at this point, I would say we still are constructive on the markets overall. We have India as our core overweight allocation within the broader region. I think our sense is that valuations are indeed expensive, but even with baking in some derating in our numbers, we think on a full year basis, market should be higher, largely on the back of underlying earnings. We still think earnings grow around 15% compound this year and next, and that should drive the markets higher. So in terms of the path to your question, I think near term, look, I think markets may kind of moderate here because growth has been moderating at ad. We also are seeing the current reporting season, which is somewhat mixed. I mean, in terms of the beats versus misses, we are almost 80% through in terms of the market cap for the headline indices. And there, I think it's like 40% beats, 40% misses, 20% in line. But more concerning is the fact that a lot of the numbers are kind of much more driven by margin expansion as opposed to volume growth. And so only 15% of the stocks have actually beaten on revenues as opposed to 40 plus beating on margins, right? So it does seem like earnings on the margin are a bit mixed. And so our base case is markets sort of consolidate here until probably sort of second quarter into the elections, and then post-elections, you start to see markets moving higher. But I think on a full year basis, still very optimistic. Think markets should be higher, 8 to 10% returns overall for the markets.
Okay, 8 to 10% returns overall for the markets. Got that. Sunil, hi, good morning. And as always, thank you for being with us on the channel. I was going through your report, your strategy report. One of the big themes that you like for 2024 is this energy transition theme. You talk about how India is growing and decarbonizing simultaneously, and there is big potential here for investors. Can you just take us through the fine print of that? If I'm an investor today and I want to capitalize on this theme, which are the sectors, stocks that I need to be looking at?
Yeah, I mean, we have been overweight that camp, Sonia. I think, as you said, the core thesis is that of not, I mean, a peak sort of power deficit in the country. So our sense is that given the demand supply in that sector, we will continue to see shortages. Obviously, with the winter months, the demand kind of came off a little bit. But I think as we start to get into March, we probably think we again should be seeing power shortages. And that means that the legacy thermal business in some of the stocks should also continue to enjoy a re-rating. So I think on the renewable side, some of the stocks have already run up. So we have neutralized view on those names. But from the core utilities and power sector, especially on the legacy thermal business, we continue to be positive on those names. So I think utilities is one of the core overweight sectors we have in there.
All right. Hi, Sunil. Good morning. Nigel on this side. I think your target on the Nifty is around 23,500 for this year?
That's right. I mean, obviously, I think you have to look at the target in the context of the broader region. Okay. So for the region overall, we have around sort of 11-12% upside for the broader region. A lot of that being driven by sort of China as well. So barring that, we're kind of looking at high single-digit returns for most of the markets. So India also is therefore in that camp. And I think the core view being that it's the underlying earnings, as I said, that will be driving markets. Yes. So with a bit of sort of low to mid-teen return earnings expectations and a bit of multiple derating, we think that's where the market ends up.
I recall that point, Sunil. You said, yes, the Indian markets have done well, but earnings have kept in step. So that's why the markets are still on a PE basis. We've not seen a big expansion out there. All right. The next big event is going to be the RBI policy for us. And in the backdrop of, say, the Fed may not be cutting as soon as, earlier thought. What are you penciling in? Do you expect the Fed to start cutting in March, or do you think that it's going to be in the middle of this year? And in that sort of a backdrop, what are you working with in terms of, RBI action?
RBI. Yeah, look, I think on the Fed call after the FOMC last week, we also pushed back our Fed first rate cut expectations from March to May. So we are now kind of looking at 5 rate cuts for 2024 overall. So 4 25 basis points sequentially and till September, and then the final cut in the month of December. So for Fed. For RBI, which by the way should be sort of positive for markets in general. I think if you go back to Fed rate cutting cycles, in general, most Asian markets on a 1 to 3 month basis after the Fed starts cutting tend to generate positive returns. So I think that should be positive overall for the markets. For RBI in particular, we obviously in the policy tomorrow, we do think they will stay on hold. And I guess the reason behind that is if you, for example, looked at the growth versus sort of inflation trade-off, our general sense is that, growth is a little bit sort of mixed. You got investment growing stronger, but consumption is still a tad weaker. Inflation is still at high above 5%, and so we think they'll probably continue to stay on hold. But I think what's more important in terms of the policy would be the focus on liquidity. And on there, I think the sense we have is that the pain you had, or the extreme pain you had a few weeks back in terms of tightness and liquidity is probably already eased given the intervention from RBI. That should be on the margin good for banks. But what they will likely do is liquidity probably stays still in deficit in the current quarter. I think Q2 calendar, the liquidity starts to ease. By that time, I think they get better clarity around Fed. And if you're right, Fed would have started cutting already. And then they start to sort of ease liquidity in Q2. And then the actual rate cuts start in Q3. So we're kind of penciling in 50 basis points rate cut for RBI starting Q3, which takes the repo rate from 6.5% to 6% on our estimates.
Right. Sunil, since you're a global house, you'll have a view on China as well. I mean, I just want to actionable for those, the market's been completely bombed out, right? Valuations are cheap, etc. Does it make sense for those with some investable surplus to put money into, and there are some of those mutual funds here which have these, China funds, etc. Put some money and just forget about it? You think it makes sense?
Yeah, look, Nigel, Prashant, you're right. The market obviously is down significantly. It's down 60% from its 2021 peak. valuations, as you pointed out, are around 8-9 times, so still very cheap. We look at a lot of the allocation data from both hedge funds and mutual funds, which are at 10-year lows. So clearly, I think the risk reward looks favorable here. I would say I think the incrementally what the government has been doing, they started with some modest easing measures in terms of rate cuts and RRR cuts, which the investors were not very pleased with. And I think the latest news flow around they setting up a market stabilization fund, RMB 2 trillion. That's what has got market a little bit of comfort, and we're already seeing some buying happening. And the move last night in terms of MSCI China of 4% is kind of reflecting of that short squeeze. So our sense is that it sort of makes sense because the risk reward looks kind of skewed to the upside. Having said that, I would say we still need more forceful policy measures from the government for investors to get comfort on. And if people have to choose within the China markets, we are much more positive on the onshore markets as opposed to offshore markets. And in onshore markets, there are a few themes more geared towards the self-sustainability, industrial automation, more kind of the hard tech, which is where we think government is focused on, that we think could do well.
Okay, by the way, the mid-cap index is now soaring, almost 400 points higher on the index, and plenty of stocks actually buzzing. INOX India, we've been talking about that ad nauseum, 1,050 now on that stock. Remember, the issue price, the IPO price of INOX India was 660 rupees a share. So it's been a big mover. Of course, it listed itself at 950, and since then it came off a little bit, but now at a fresh high there, 1,050 on INOX India, doing pretty well. Paytm is up almost about 10%, so don't lose sight of that. And something like EIH is up almost 16%, so big moves there. But Sunil, in your report, one theme that you really like is the defense theme. You talk about how indigenization is something that, could lead this sector to move higher. But the problem here is that there seems to be too much of a run-up in stocks, maybe a little bit of over-ownership as well. I mean, something like a BEML is up 170% in a year. So do you think that this story has played out in its entirety?
Yeah, Sonia, I mean, that's a good question. Let me step back a little bit on the broader sectors. Look, I think if you look at the medium-term themes, some of these, whether you call some of the Make in India PLI stocks, some of the industrial names there, some of the defense names, you're right. I mean, these are longer-term themes we still like and we have extensively written about. In the near term, some of these themes have done fairly well. And so maybe sort of market takes a pause here. But I would say in terms of the broader themes within the industrial bucket, I would say where we still think there is more juice left is probably more around the building materials theme, because we still think that the real estate continues to recover there. Obviously, the real estate stocks themselves have priced some of that already in. But if you look at the broader building material themes, for example, in terms of sort of adhesives and pipes and laminates and plywoods and all of that, that's a theme, for example, which hasn't been sort of fully priced, and we think there could be some more upside there. But I think to your original question in terms of defense and some of the other sort of industrial names, we do think with a bit of capex, new fresh infra kind of slowing down here and run up in those names, they could probably take a bit of breather in the near term.
Okay, Sunil, we'll leave it at that. Thank you for discussing all of your themes with us and your target on the index as well. It was a infotainment, as we call it, right? Information, but entertaining as well. Thanks for being with us on the channel. Well, that is the word coming in from Goldman Sachs. But let's get back to the market now. Almost at 22,000, come off a little bit from the highs. But the mid-cap end of trade is doing pretty well, 300 points higher. Let's talk about TTK Prestige. Q3 was a steady quarter for the company. The margins were flat sequentially. Domestic sales growth is in single digits, although the export sales are up 21%. TT Jagannathan, the chairman of TTK Prestige, joins us now to talk about that. Mr. Jagannathan, good morning. Thanks a lot for joining in. Last month when we spoke, actually in December when we spoke to you, you said that Q3 is better than Q2, but not extremely strong, and you hope to end the year flat, the year FY24. Any change that has taken place since then? Has demand come back, or is it still the same?
Actually, demand fell off in December steeply from October, November. So what we expected double-digit growth in the third quarter, we landed up only with about 6.3%. And demand is still very tight.
Okay, demand is very tight, you said, right? So this 5% domestic sales growth is what you saw in Q3. You think there's any scope of getting to double-digit, or is it unlikely in Q4?
It's unlikely in Q4.
Okay. And by the end of the year, you still stick to a flat growth. I'm just trying to understand when do you see some signs of recovery come through, some signs of perhaps double-digit growth returning?
No, the both Q3 and Q4 will be better than last year. So there is growth has started. We still have to make up for Q1 and Q2, which is where the problem is. But it is looking good. It's not looking as bad it was in Q1 and Q2.
What is the reason, Mr. Jagannathan, for demand, as you said, falling steeply? What happened? I mean, are there any reasons?
We believe, and I'm not an economist, but we believe that the discretionary spend has moved off to travel. So luggage, hotels, airlines are all booming. After 2 years of COVID, people have, we had a great time in COVID because people were stuck at home and they bought a lot of cookware. Now the reverse is happening. They're traveling, they're eating out. So the share of wallet for our business has dropped. It will come back. It is all cycles.
Got it. All right. Hi, Mr. Jagannathan. Good to hear your optimism. So for this year, you're saying you lend flattish, right, in terms of revenues. For 9 months, is a bit of a degrowth. For the year, though, you're saying flattish revenues, correct?
Yes.
Okay. And how does FY25 shape up from here on, since you're going to have a more or less flattish year and hopefully demand comes back? And also, what does it mean in terms of margins? Earlier, you were guiding for margins, I think, in the vicinity of around 14 to 16%. That's not yet achieved.
Margin. We have not sacrificed our margin. We have not bought sales.
Right.
We're maintaining our margin. We're looking at a reasonable growth for FY25. Nothing dramatic, probably high single digits.
Okay.
And we'll maintain our margins.
Okay. You know, sir, but when we had spoken the last time, you were indicating a rough range for the margins of around 15 to around 17%. I think as of the 9 months, you're almost at that 15% odd mark. So
Yes.
from here on, what is the margin trajectory? We get that high single digit growth for FY25, but are there levers in place to improve even in terms of margins?
I doubt that. I think if you maintain 15%, I'll be happy.
Got it.
Okay, maintain 15% margins. I just want to come back to the earlier point you were making. It's interesting, right? You say that the share of the wallet has decreased because discretionary spending has moved to perhaps luxury, travel, luggage, etc. But then what gives you the confidence that things will come back so soon? What if this is a secular story for the next couple of years?
I have been in the business for 50 years and I've seen several cycles. These things come and go. They will.
Okay. No, I get that. But can you give us a little more color into the demand trends? What are you seeing in rural, urban, tier 2, tier 3 cities? Because I understand that this K-shaped recovery is more in the urban side of the market, right? Luxury, premium end of the market. But what about rural?
Rural is slower. The growth is slower, but there is some growth.
Slower than urban or slower than what you've seen in the past?
It's slower than the company growth.
Okay, rural slightly slower than the company growth. In terms of the channel to the market, I mean, is it even across general trade, e-commerce, or is one faring a little better than the other?
E-commerce is doing a little better than general trade. The large format stores are doing well. It's the mom and pop stores that are struggling.
Okay, all right. I was also reading that has sort of smaller sort of regional players in terms of competition, has that intensity increased a little bit as raw material prices have come off? Mr. Jagannathan, have you seen that?
No, if you look at our peers for the quarter, we've outbeaten all of them, and we're not worried about smaller players.
Okay.
Okay, all right. What about the exports market, sir? By the end of this year, you think you get to that 100 crore mark?
Easily.
Okay. And what about next year? How much does export scale on that base of 100 crores?
My wishes out, but next year we should double.
Okay, so close to 200 crores on exports at least.
Yeah.
You know, Mr. Jagannathan, when the markets are a little bit jittery, demand is a little bit soft, it sometimes throws up some good opportunities. And you have been on the prowl. You have been telling us that you're looking at various assets, but you're not yet ready, to make that announcement. Do you think in the next couple of quarters, you have got that target out there, demand is a little bit weak, which may not be such a bad thing, the acquisition target could want to sell out? Is that a possibility?
It is.
So should we hear it for the next time we chat at the end of this fiscal?
I doubt that. I doubt
And the-
things don't happen overnight.
And this,
And the target, I think, was around 500
Yeah.
to 100 crores of revenues, right?
Yes.
500 to 1,000 crores of revenues. Got it.
Yes.
So sometime in the first half of next fiscal, not overnight, but we are giving you 2.5 quarters. You think it'll
I am
close out?
not committing. I am not committing.
Okay, interested buyer, but not committing. So
Hopefully we'll hear about it soon, right? Sooner rather than later. But we had...
Absolutely.
Okay, that's enough for us for now. But what about the new launches? You introduced 25 new SKUs in the last quarter, actually, across all categories. How has the response been?
Very good. In fact, that's what sustained us. The upper end of the market is doing very well.
Okay, so the upper end of the market is doing well. What about Judge, the new brand? That's in the mass market category. How has that done? It was doing a good growth rate, right, of around 40%. Is that something that's sustainable?
You see, growth rates are deceiving. If you're selling one and you sell two, it's 100%. But if you're selling a million and you sell to 1.2 million, it's 20%. So Judge is such a small brand that growth rates are deceiving. We'll still grow at 100% from 1 to 2.
okay, all right. Thanks a lot, Mr. Jagannathan, for joining in and filling us in with your take on the business as well as on the industry and how the share of wallet has changed in the last couple of months in comparison to COVID period. Always good speaking to you. Well, let's focus on the next management then. NLC India reported a rather weak set of numbers in the last quarter. Their margins have contracted a little bit. Revenues as well are down. Mr. Prasanna Kumar Motupalli, the chairman and managing director of the company, joins us on the show. Hi, sir. Good morning and thanks so much for joining in. Well, tell us what went wrong in the past quarter and are things on recovery mode?
Yes. There was improvement in the quarter 3 compared to quarter 1 and quarter 2. And quarter 4, we are doing much better in both in the coal production as well as the power generation. So we are hopeful that in the quarter 4, we will be doing much better and reach our whatever targets are there.
Okay, you'll do much better in quarter 4. Can you tell us, in the power segment particularly, what led to the dip this time around? Was there any disruption that you saw in your plants? And can you give us some sense of what the pricing and volume trends could look like in Q4?
Particularly in quarter 3, most of our plants located in Tamil Nadu, they got affected because of the floods and rains that happened. Because of that, there was a stoppage of the units for almost more than 10 days. That is the reason why the operating performance is comparatively not to the extent which we expected. But in the quarter 4, we are doing well. And in thermal power generation, it's growing at the rate of almost 9%. So we are expecting to meet that growth rate in our company also.
Okay, all right. In terms of your, if I look at the power mix currently, 72% is in favor of thermal, while I think renewable is around 28%. But you have ambitious targets for 2030. So could you tell us how this mix will change?
Actually, as on date, we are a 6 gigawatt company with around 24% renewables and balance conventional thermal capacity. By 2030, we are targeting to become a 17 gigawatt company, where 11 gigawatt from thermal and 6 gigawatt from renewables. The percentage would be around 32 to 34%. And to meet that target, already projects are in pipeline. The renewable capacity of 2 gigawatt projects are already in pipeline in different states. And we are expecting the completion of those projects in next 1.5 years.
Okay, all right. So here's Nigel asking you about Nigel, sir, because you've incorporated a newly owned subsidiary, I believe, which is NLC India Green Energy Limited, which is incidentally, I think you have put it out as Nigel. So tell us what is the outlook in terms of this subsidiary and how will it go about its business?
Actually, we formed this subsidiary, 100% owned subsidiary, to focus more on green initiatives and renewables. So whatever new projects that are coming, we are adding through this Nigel. And the project in Gujarat is a 600 megawatt, the 810 megawatt project in Rajasthan. All these projects we are adding to Nigel. And also we formed one more subsidiary, NLC India Renewable Energy Limited, that is also 100% owned subsidiary. That we formed for the asset monetization of our existing assets of 1.4 gigawatt.
Okay. All right. Sir, Nigel is wishing Nigel all the best in particular, with regard to the outlook on the green side of business. So I had to chuttar it, sorry.
Okay. No, that's fine. But can you tell us a little bit about the total capex as well? You have, 82,000 crores in order to reach the 2030 target. How are you planning to fund a lot of these expansion activities over the next 12 to 18 months? In the past, a lot of these projects of yours have seen delays, right? Because of either land acquisition issues, cost overruns, etc. What is the way forward now?
Madam, as you rightly said, we are having capex target of 82,000 crores by 2030 for adding almost 11 gigawatt capacity. Recently, Honorable Prime Minister laid foundation stone of our Talabira thermal power station, 3 into 800 megawatt in the state of Orissa, with an investment of more than 27,000 crores capex. And we will be adding a capex of 46,000 crores by 2030 in the thermal power generation, 24,000 crores in the renewables, and balance in the coal mining. We in the conventional thermal power generation 70-30 debt equity ratio, and for renewables 80-20, we require around 21,000 crores of equity, and we are planning to fund this equity through the internal resources and the asset monetization program which we are doing for our renewables of 1.4 gigawatt. And NLC being a AAA star rated company, the debt is not a problem.
Okay. So, what do you see? I mean, no, just trying to understand how much of it will be funded through equity, you said?
21,000 crores.
21,000 crores. And the rest?
Rest through debt.
Rest through debt. Okay, so what would this mean for your overall debt on the company over the next, say, 12 to 18 months?
Pardon, madam?
So what would this mean? If you can just help us with the balance sheet as well, what would this mean for the overall debt of the company over the next 12 to 18 months?
Next 12 to 18 months, there will not be that much change about the debt on the company. But by 2030, for this 82,000 with the 82,000 crores capex infusion, around 60,000 crores will be the debt on the company.
All right, we'll leave it there, sir. Thank you very much for joining us. And we wish you all the best of luck for business. Speak with you soon again. That's NLC India. The market, by the way, has given up about half of the gains which we had. We are up about 40, 45 points. So not a one-way kind of a day. There is, I mean, actually, even yesterday we had, a little bit of up and down in the first hour, and then the market picked up a trend and then marched up and up for the rest of the trading session. What we'll do is we'll take a quick commercial break here. We'll connect with the management of Godrej Properties when we come back on the third quarter numbers. That's coming up. We'll also have the management of Nazara Technologies to talk about their results in a bit from now. Stay with us.
Well, Godrej Properties saw its highest ever quarterly sales in Q3. However, volumes came in lower. Their booking value is up 76% year-on-year, while collections have also surged 43%. My colleague Sonal caught up with Gaurav Pandey, who is the MD and CEO of Godrej Properties, began by asking him about the company's sales and bookings and also on the volumes of the company. Listen in.
Where we're headed towards very exciting phase for us. We've done 13,000 crores worth of inventory sales, which is 6% higher than the last financial year of entire financial year of sales. So we're actually doing far better than we frankly expected ourselves to outdo. So yeah, very exciting phase for us. On the question on the volume growth over value growth, I think frankly it's determined on the projects that we are launching. So if you see all the recent acquisitions that we did in the last 18 months were largely not in the mid-income, but slightly on the premium and premium plus kind of a category, where your average realizations are better, your margins are better, and therefore it's sort of you're moving up the value chain. So instead of million square feet, your metric that you tend to target more is on the booking value that we are looking at. So yeah, I mean, and I think 9-month basis, probably our sales is probably about 11 million square feet, which should be higher than the 9-month performance. But yeah, but frankly, the directional call is more to grow the portfolio in terms of top line growth as well as margin expansion.
Okay, all right. Of course, that means that your portfolio is also skewing towards the premium side. That seems to be doing really well as well. What is the idea around expansion from here on? You have your presence across geographies. You're one of those pan-India players. Will it come in via more land buys, or you've already done that and now is the phase when you'll see a lot of construction? What is the business development pipeline looking like?
It's a great question. See, essentially, if you see, we're a very unique platform present across all geographies. So for us, our job is more like a portfolio manager. You tend to take sort of directional views about where the market is presenting you opportunities, and you tend to manage your portfolio basis where the sales velocity is better and your risk adjusted returns will be better. So last 18-20 months were a series of acquisitions we had done across all geographies because we wanted to deploy a lot of capital. And from there on, we've moved to more of execution heavy focus, which is why you saw the later part of the last 6 months or so of last calendar year being more on execution, because we wanted to launch some of the acquisitions we did, which is where you saw Godrej Tropical Isle getting launched in Q2, became the highest selling project for us with 2,000 crores plus of sales. That was a record that we broke our own record after 7 years. And Q3, we broke the same record with another launch of ours in Gurgaon, called as Godrej Aristocrat, which 2,600 plus crores of sales. Now, the strategy is about calibrated BD, which is essentially adding inventory and doing acquisitions where we feel there is big opportunities to grow. At the same time, replenish inventory where we are selling fast. So, for an example, South is going to become a sort of an area where we'll be very focused towards making our presence, which is why you saw sort of an announcement in early January in Yashwantpur market. You may see similar announcements in South going forward. And likewise, we will make inventory replenishment kind of calls, or where we see huge opportunity of margin expansion. So it's a calibrated BD strategy to keep continued growth. But frankly, from a hygiene level of growth to deliver, we have enough and more from an inventory, thanks to the great acquisitions our team did in the last 20 months or so.
Okay, all right. So that is one strategy that Street has been focusing on as well for Godrej Properties. Gaurav, what does it do to your capex going forward? What will debt look like? Because the last conversation I had, you did indicate that since you're looking at expansion, debt would continue to increase. But what levels are you comfortable with? Right now, we are standing at 6,900 crore rupees. What does it do to cash flows? Because operating cash flows to overall cash flows has been around 30 to 40%. Is this something that will continue?
See, if you see net D ratio that we have already talked about and given as a guidance to the street has been 1:1, because that is a level we feel that we are able to balance both the risk side of the business, but also the opportunities and the growth levers that we want to intact. On the operating cash flow, essentially we see our business, in Q3, we did about 2,411 crores worth of collections, which was like a 43% Y-on-Y growth. From a 9-month point of view, it was 6,700 crores. These two metrics led to a major swing in our operating cash flow. So net operating cash flows in Q3 was 798 crores, which was probably 35% Y-on-Y growth. And if you see from a 9-month point of view, sorry, it was 45% on that metric. And on 9 months, it was close to about 1726 crores. About, say, I think 34% kind of a Y-on-Y growth. So having this 1726 crores of operating cash flow in 9 months, with the headroom that the net D is anyways presenting as an opportunity, I believe we have enough and more to continue our growth drive. But of course, in markets that we feel the margin expansion opportunities available. And so, frankly, growth led calls are a lot of times dependent upon how your projects are happening. So if you see our launches, they are frankly outdoing our own internal benchmarks we've ever done. I talked about some of the launches, but look at launches like Godrej Ananda in South, which is a 574 crore sales, practically sold out. Whatever inventory we had, more or less completely, it's flying off the shelf. We had a project called Godrej Avenue 11 in Mahalakshmi market of Mumbai, which was a late September launch, and it was something like 330 odd crores we did in Q3, but we did another 350 plus crores in Q3. So it's something like 687 crores in practically 4 months. So when you see this kind of uptake, I think it requires prudent reinvestment strategy, but of course, very targeted, very specific, where you're very confident on margin expansion and sales growth.
Okay, all right. Last question before I let you go. Deliveries, the guidance that you'd given, 52% of that has been achieved. For business development, 56% is achieved. You're confident Q4 will take care of the rest of the guidance?
Yeah, I mean, to be very frank, when we see guidance, especially on metrics like business development, I think we're not really pressurized to meet the guidance. It is more about if we see the opportunity of investment available, we might even do more and we might be slightly less. But of course, endeavor is always to hit the guidance on BD. But there is no desperation to hit the investment target per se. But yes, on the execution side, as you rightly mentioned, we did about close to about 6.5 million square feet of occupancy certificates, led OCs, basically projects that we got in completion. That is a guidance we have given to the street at 12.5 million square feet. So heavy Q4, and I think very reasonably very confident that we should be able to hit that as well. So that's sort of a metric that we are very focused upon. And business development, opportunities currently suggest we should be able to hit it and frankly even exceed it. But we're not driven by that. That's the only limited point.
Okay, all right. Well, let's focus on a couple of stocks that are in focus. Naven Florine is down in trade on the back of a weak showing in Q3. Sonal's tracking that stock. She's going to give us a quick analysis. Sonal?
Well, yes, it was a weak set coming in from Naven Florine below the pole. In fact, a big miss on margins that came in at 15.1% versus a pole of 22.2%. Even on a YOY basis, it's a weak set. Revenues declined 11%. EBITDA is down 51%. Margins, they have contracted around 1,200 basis points, leading to a profit decline of 27%. Now, the company in its con call did indicate about the new CEO that they have shortlisted some candidates and they will be deciding on this soon. This will be a big trigger for the stock because since the time Mr. Radish Velling has quit as the CEO in December, there has been no update on that. So this is one thing that the street will be watching out for. It has been underperforming since. They said that business was impacted. It is because of deferment of campaigns. There was no cancellation. They will be doing it in coming quarters and margins will see a recovery subsequently. Specialty and CDMO recovery is tilted towards second half of FY25. So still looks like there's some time for recovery as far as demand is concerned and pricing is concerned as well. So the stock will be in focus on the back of that.
Thanks a lot for that, Sonal. But our eyes need to go on IEX. That's because of the flashes that are up for you on the screen. Remember, despite the numbers looking good, despite volumes picking up, this is the big, risk to the stock. And now the problem is that CERC has provided enabling provisions to implement market coupling of power exchanges. That's what will make, IEX lose their current edge, in the markets with regard to the volumes out there. And that explains why the stock has come in there. So any kind of movement on power coupling, well, market coupling, that's not very good news for them. And CERC says that the necessary software to develop in 2 months, they're currently running a shadow pilot for this particular, market coupling. So we'll try to get in Vivek to give you more details. And this has always been an overhang. So irrespective, the performance is improving. Till we get clarity on this front, it's a problem. And now there appears there is some forward movement. So that's the reason why the stock has moved to the low point of the day as we speak.
Okay, by the way, the market, a lot of interesting stocks, you need to keep an eye out on. Indian hotels is at a fresh 52-week high. So just keep an eye out on that. It's been a big theme, right? This entire travel and luxury space. But let's get back to tracking IEX. Vivek is here to give us the latest on that. Vivek, over to you.
Well, absolutely right. So this has been an overhang as far as IEX is concerned for quite some time now. So last what had happened was that CERC, which is the market regulator, had gone ahead and asked all of the stakeholders as far as the power exchanges are concerned to go ahead and give their comments as far as implementation of market coupling was concerned. So all of the participants have gone ahead and given their recommendations to the committee for this particular market coupling. So after that, CERC yesterday, this is a document dated 6th Feb, has gone ahead and said that now we will take one step forward. Number one, they're saying there is a need for more evidence-based results. Along with that, they are saying this particular results will actually help us decide on the potential benefits that market coupling can give to market participants of the power exchange and to the overall power system. So what is it that the CERC has directed Grid India to do? They've gone ahead and directed the grid operators to run a shadow pilot of market coupling for the next 4 months. That particular market coupling pilot will start once the software for the implementation of market coupling is ready. Next, what will happen is that Grid India will develop the software. This is for coupling of RTM, which is the right to match. Along with that, there will be a coupling that will be implemented, number one, in the day-ahead market, the DAM market. Also SCED, which is Security Constrained Economic Dispatch, that too will be taken into account. And lastly, the day-ahead market for all of the 3 exchanges that are currently competing. Post the 4-month implementation of the dummy pilot, post that is when CERC will go ahead and take a decision on how and when to implement market coupling. But overall, this continues to remain an overhang as far as IEX is concerned. And if market coupling is implemented in the Indian power market, that is expected to take away significant market share from IEX and then go ahead and give it to the other power exchanges that are there in the market.
I don't got that. Vivek, we've been discussing this. The power minister earlier this year, on the 17th of January, had made a comment that I think it was our network reporter who had kind of sat down with him and asked him about this coupling business, and he'd said that we will implement it. It's one nation, one grid. Those are his comments. And at that point, many were kind of saying, well, it is CERC's decision. It is not the government's decision. But I think now it is pretty clear that this indeed is going through. Thanks very much, Vivek, for running us through this. We'll try and have the management of IEX also join in for more on this story. Stocks down about 4% or so. Now, the next company in our radar is Nazara, which has reported a muted set of numbers. Revenues have not really picked up as the company had said they would in the third quarter, actually in the second half. So let's understand what happened. Mithir Sen is Joint Managing Director and CEO of Nazara. Thank you very much for joining us, Nitish. Prashant this side, morning. Can we start with the revenue number? What's the reason behind the muted performance?
So sure, Prashant, as you will appreciate, we are running a marathon and not a 100-meter sprint. And for us, the quality of revenue, improving margins is equally important, and it's not about growth at all costs. In this quarter, we saw some challenges in our AdTech business as well as our open play business, which is the skill-based real money gaming. As you know, that is impacted by GST. So some of the top line took a hit because of that. But as you can see, despite flattish revenues, our EBITDA has grown by 24% and our PAT has actually grown by over 40%. So I think for us, it's really important that we're setting a very strong platform and very strong foundation for much larger growth in the coming year in a very profitable manner.
Would you say, as compared to what you yourself guided on the con call after second quarter, this is a bit of a, you were expecting better numbers? So maybe unexpected challenges?
I think we expected the AdTech to grow a bit better. And also the impact of the RMG business came in from 1st of October. So you're actually seeing this full impact in Q3.
On AdTech particularly, revenues have gone down 44% in Q3 and Q2 it was down 37%. You spoke about the loss of one customer as well. What's the latest on that?
So you're referring to the AdTech business because our overall revenue is up 2%. So
I'm talking specifically about AdTech, yeah.
Yeah. So for the AdTech business, you're right. Year-on-year revenue decline was 44%. But the good news is that our EBITDA year-on-year is down only 17% in this quarter compared to 9 months, 39% or so. So we're actually catching up on the EBITDA very fast because our AdTech margins have gone up quite significantly. So I think we're in the right direction. And I think next year you will see a resurgence in this business for us.
Okay. across the board, actually, there's a bit of pressure in most businesses. I mean, Kiddopia, for example, is struggling to get new subscribers. Gaming revenues are down in Q3. Just trying to understand, are you expecting any revival anytime soon?
Absolutely. So I think two standout performances for us in this quarter have been Animal Jam, where we've seen the highest quarterly revenues in the December quarter, both in terms of profitability. And Sportskeeda is actually year on year 97% up on EBITDA. So I think our platform is well diversified. And despite the challenges you just mentioned, we are able to grow our profitability and withstand some of these pressures. So when things are better, you can imagine how we would grow.
Yeah, but when do you expect things to get better? And on an average, what are you expecting in terms of subscriber growth for Kiddopia?
Right now, it's difficult to say. Kiddopia continues to have user acquisition challenges, and we're working hard to improve it. But we're also trying to break the logjam by doing some IP licensing. We've seen some of the kid interactive companies globally do much better through licensing popular IP, which we haven't yet done in Kiddopia or Animal Jam. We're in advanced conversations with some large global IP holders to do this in the kids space. And I think that could be one great way for us to kind of bring back this, momentum to this business of Kiddopia.
Nitish, for the 9-month period, revenues are up about 9%, and I think margins are up about 180 basis points. Yes. Could you provide us with some sort of guidance for the full year? What will the numbers look? And for FY25, what should we expect?
Yeah, I don't have a specific guidance for the full year, but for FY25, I think two things. I think many of the challenges we faced in terms of the top line, for example, DataWorks, our telco business, etc., will be in the denominator already and won't hurt us next year. So a lot of the businesses that are growing for us should shine more or should impact the top line more in an organic way in FY25. The other important thing to remember is Nazara has been able to raise 760 crores from marquee investors this year. We brought in Mr. Nikhil Kamath. We brought in SBI Mutual Fund, ICICI Prudential Mutual Fund. So some very marquee investors have backed us, and that has taken our cash reserves in excess of 1,500 crores. My team has worked on a fantastic pipeline of investments as well in the last year. And we also hope to action that. So I think FY25, you will see strong organic growth resume, as well as additional growth coming through new M&A that we are going to do.
Okay.
Could you provide us with some idea about, without a specific number, margins? Because third quarter margins are around 14%, 9-month margins are around 12%. I mean, what's the where will margins be?
I think Q4. So for the full year, the margin should be between 12 to 13%. Q3 is usually the highest margin quarter for us. But our push for across our businesses is to improve margins. I believe a gaming business should be a high margin business. It's not a 10-12% margin business. And while we've invested in growth, I'd like to start seeing much higher margins come through in the next couple of years. And that's the push my entire team is working on.
Okay, I just had one more question on real money gaming, right? The EBITDA loss that has been reported, that is as expected. But in Q2, you had guided for Classic Rummy to post an EBITDA loss in Q3 before stabilizing to break even by Q4. Are we on track to seeing that break even in Q4?
Yes, we should be able to achieve that.
Okay. All right. Thanks, Nitish, for joining in and giving us your view on the earnings. That's Nazara Technologies with their numbers and the pressure that they're facing in certain businesses.
Just one point, Sonia. I wanted to highlight TRF. The stock has suddenly gone to upper circuit up close to 20% because there's a release that's come on the exchanges. And they have said that the board has decided not to go ahead with the scheme that was announced earlier. Remember, earlier they were talking about, swapping shares. If you had 10 shares of TRF, you would get close to 17 shares of Tata Steel. So earlier it wasn't in favor of the shareholders. Now, if the scheme is not going to go ahead, then, that was what the ratio was, keeping a lid on the stock price. And that explains from the minute that release hit the exchanges, that stock has moved to upper circuit, up close to around 20% as we speak. Very small company, less than 400 crores. We just thought we'll highlight that for our viewers. For the time being, we'll slip into a short break. On the other side, we'll have our special segment, It's the Economy. Lata will be joining in to give us more on that. Stay with us.
Welcome to It's the Economy. The Reserve Bank's monetary policy is less than 24 hours away, and there have been a few important changes in the past month that we will take note of. One, the government has kept fiscal deficit lower than expected, and that is a disinflationary sign. Two, the November and December CPI numbers came in lower than the Reserve Bank's own forecast, of course, lower than market forecasts. And three, most important, the Reserve Bank has provided liquidity of 2.5 lakh crore through variable repos and has brought down the call rate from 6.75 that it prevailed from August to Jan to 6.5% today. So, do all this mean we can get a dovish policy tomorrow? I have with me Ashish Vaidya, the Managing Director and Head of Treasury and Markets at DBS Bank India, and Pranjul Bhandari, the Chief India Economist at HSBC India. Pranjul and Ashish, thank you very much for joining me. Well, Pranjul, to you first. Inflation numbers down. Is all this adding up? I mean, deficit also down. Is all this adding up for a macroeconomic argument for the Reserve Bank to get more dovish?
Yes, I think so, Lata. It rarely looks so good because we have growth which is strong, but it is maybe going to be slightly softer in the next year compared to the previous year as the fiscal impulse turns a little negative, or as credit growth softens a little bit. So strong, but not so strong. We have inflation numbers that are likely to be much lower in the next couple of months. In fact, our census January inflation is at about 4.5%. I think we are at track at getting 4.5% for the year for FY25 as well, which is RBI's forecast. We have a rupee which is very well funded. If anything, there's appreciating pressure on the rupee, which again is good for inflation control. So it doesn't get better than this. And then, of course, you also mentioned the fiscal being extremely disciplined. So my sense is that, yes, in the next couple of quarters, as fiscal takes a slight step back, my sense is that monetary conditions will be eased slightly. It'll take a step forward. And I think, we will start seeing, we've already started seeing that in the sense that the call money rate has fallen from 675 to 650 already as the government has started spending. But my sense is the RBI will formalize this, maybe not as early as tomorrow, but my sense is, around June, middle of the year, they'll formalize it. And towards the second half of this calendar year, we can have some slight rate cuts.
Okay.
But I just want to take a step back.
What do you mean?
See too much easing.
What do you mean by formalize? You mean they will say stance change?
That's a toss-up. Or to be honest, the de facto stance is already neutral because the call money rate has come down and is now tracking the repo rate of 6.5%. But my worry is that they may not want to formalize it tomorrow. They may leave it for a couple
What do you mean by formalize?
So right now, the term that they use is withdrawal of accommodation.
Okay.
Maybe call it something like, we're happy with what it is right now, not withdrawal of accommodation anymore. But I don't think that'll happen tomorrow for the simple reason that you also see the RBI gets very nervous about a call money rate falling even a little bit below 6.5. So they're a bit worried that they give a finger to the market and the market grabs the hand. So I think tomorrow they won't rush into it.
Okay. Ashish, similar question to you actually, taking from what Pranjul says, the RBI gave 2.5 lakh crore, but the moment call went, even there was one tick below 6.5, they also did a reverse repo to take back the money. In fact, not one, but two. So, are you expecting anything, in the stance language or even in the guidance to change tomorrow?
Well, thanks for that. So, I think as far as the stance is concerned, I don't think they're going to tinker anything around with the stance. I think it's going to remain at removal of liquidity or removal of accommodation. I think interesting things to understand and put it in the context is that since August, September last year, the government had, the RBI had clearly kept its deficit in the liquidity fairly tight. And that resulted in almost a 20-25 basis points tightening, which ideally is not really noticed by the market, but it actually trickled down into the real economy, and the deposits and credit rates actually moved up. So I think the actions in the last few days are clearly pointing towards a more comfortable situation. And I think the reversal also happens the way the tightening happened. So I think we will look at reversal on the liquidity, though they might not specifically say that. They will obviously say that the inflation is well managed because of tightened liquidity conditions, and accordingly they will keep system fairly balanced. I think, and inflation continues to be on the priority. I think what interesting thing might happen is amongst the 5 MPC members, this time, every time you have seen about one member saying move it to neutral, this time probably you could see 2 members moving into neutral. So that will give a sort of a soft indication to the market. But I agree with Prajul that if you actually change the stance, then the market will really start multiplying the moves.
No, that's a very good one. So one thing, Ashish, one thing we all should look for, therefore, is the vote. Will there be 2 people voting for neutral in the MPC? What other things train my eyes to what I should watch out for, either in the talk or in the statement?
So my sense is that I think in the last policy, clearly the policy was very hawkish on making sure that the inflation is the top priority. I think it continues to remain inflation a top priority, but I think they really pat themselves on the back, and it's actually worth it that they have really managed inflation well. And it's sort of, I really don't know, but I think the wordings will be a little bit softer than what we've seen last time.
Okay.
And that itself should be a good indicator as to how things will pan out.
Okay. So vote and wording. Pranjal, what would you watch out for? Are they likely to even lower the inflation forecast for the current year? Because clearly they are going to, go lower than their current forecast. You think they will show that, yes, inflation can be 5.3, 5.2 rather than 5.4? Anything like that this year or next year forecasts?
I don't think the FY25 forecast will be changed because I think it's just right at 4.5%. For this year, yeah, it could be nudged a little lower to closer to 5.2. But, they can do it this time or they can do it next time. I don't think they like to make change every single policy. So I don't think the guidance will really come from there. I think the guidance will mostly be on, their commentary on inflation, how, there is this disinflation that is going on and whether they think it is long lasting and whether they are closer to their 4% target, the qualitative assessment of that. One other thing I'll be looking out for, and hopefully it'll get covered in the press conference that the RBI does, is this government not spending for long periods and government cash balance at RBI remaining extremely elevated for many months at a go. If this is going to become something that happens year after year, we saw it last year, we are seeing it this year, what is the RBI going to do? Because this starves the market out of liquidity for many months in a row. Maybe we needed it last few months because anyway there were food inflation pressures. But over time, over years, if we see this, then it could hurt a capex cycle, right? The private capex cycle. So what does the RBI do here? Does it use short-term rates, methods like VRR, VRRR to tide by these situations? Or does it go on to something like incremental CRRs, which I think you've discussed in other sort of panels as well? Although my sense is using CRR, which is a permanent tool for temporary, may just give extremely confusing signals. So what will the RBI change to tackle this situation?
Yeah, will there be an institutional answer? I mean, they have enough tools even right now. They can do a reverse repo to give the money to the banks, or they can do an OMO. They can buy bonds from the market. But all this will have other market implications. So will they have an institutional mechanism? And ICRR is a 15-day thing. So maybe that's an idea. But you expect anything as lasting as that, Ashish? An institutional answer to answering liquidity, volatility?
No, I don't think I'm expecting anything of those. I think it's important to realize that there is the overall economic environment is quite volatile, and the current toolkit is sort of enough to handle that volatility. Only thing is the RBI has to be daily at it just to manage the liquidity. Okay. But I think I'm not seeing any move towards any institutionalizing framework of managing the liquidity.
Anyway,
I think the current framework is good enough.
Got it. Yeah, I guess they will work within the framework. If at all, it will be a longish discussion. But, they've sprung the SDF on us pretty suddenly. Just a year ago, they have put in institutions and instruments quite suddenly into the market. I wouldn't be surprised, but maybe this is not the hour. Ashish, very quickly, what is the kind of range you are looking at? You see the 10-year, in case there is a slight hint of dovishness, go even below 7? And has the call rate peaked in your estimate as of now?
So first of all, on the government bond markets, I think very constructive on the government bond markets, looking at how the fiscal is getting constrained, the fiscal deficit. Then importantly, looking at the topping of the interest rate cycle, and coupled with that, the bond index inclusion. If overall global macros remain stable, I think we are headed directionally lower. And directionally lower, I mean probably about 675 to 6.5 over the next few quarters. Clearly, that's positive. On the liquidity side,
yeah.
On the liquidity side, I think we will look first at neutral liquidity and eventually moving towards a sort of a rate cut or a change in stance, so that the market indications enough. But the caveat to all this is that you need to be careful about any geopolitical events, and that could put a new spin in the wheel. I think one needs to be just careful about that. Otherwise, I think structurally, India is very well placed.
Ashish, out of time. Ashish, out of time. I'm sorry. I got it. Or actually, very sorry to stop you. I'm out of time. Pranjal, just one word. Will they increase the growth forecasts?
No, I don't think so. I think they're just right with their growth forecast as well. The governor has a personal preference for even higher number, but I think it's too early in the year to sort of make changes on that front.
Okay. Well, actually, TV Somanathan told us in the interview that he's working with 6-something for the next year. So he wasn't with the governor's 7. I was just wondering if we will get a full year forecast, right? The MPR is next policy. We will get a full year FY25 forecast from RBI?
Yes, I think so. Although I think it could also come in the next time. So it depends on them.
All right. Well, those are the things to watch out for then. Do they do something to the inflation forecast? What kind of a growth forecast do they give, if they give? But most importantly, as Pranjal and Ashish say, watch out for the wording to see whether there is an indication that withdrawal of accommodation as a stance changes. There are some in the market, a few, who are betting that the stance can change as early as tomorrow. If that does happen, then, okay, we have seen the best of deposit rates. So all of you go and put your money in the best FD you get, because it's likely to be lower in the coming weeks. We'll wrap up on Bazaar on that note. Chartbusters coming up.